Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Charts.Markets.com runs down the major markets. He tells us the stock market corrected to where it should be, gold has taken off, and uranium was the hottest commodity. Publisher of the Trends Journal, Gerald Celente, says we're in one of the most crucial times humanity has ever seen, warning America has become the country the Founding Fathers fought against. He believes gold has a good shot at reaching $4,000. Author of the new book, Mega Returns, Profit from Maximum Pessimism, David Skarica, talks about Bitcoin, copper, crude, lithium, and uranium. He believes gold miners are still undervalued. Publisher of the Schachter.Energy Report.ca, Josef Schachter, drills deep into the energy sector and tells us what Canada needs to do to boost its economy. He also has a special offer for our listeners. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Charts.Markets.com, where you'll find insightful commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be back, Jim.
Ross, how would you describe what happened on the stock markets this week?
Well, we had a pivotal week just a week ago. Pretty much most of these markets hit extremes. You take a look at the rally in the S&P from that April 7th low, pretty much uninterrupted right up until we had the high here on the 19th of the month on the S&P. And on the other side of the coin, you were having the same thing happen in the currency market. The U.S. dollar had just a phenomenal rally. The gold market took a hard break, and guess what? Everything reversed. So you got early part of the week, Moody's did the downgrade, so they are now the third of the rating agencies to come up with a downgrade. It was a non-event on the first day, but the reality here is that things are not good, and this rally is way ahead of itself. The pullback that we saw in the S&P pulled back right back to the 20-day moving average. Technicals indicate that should be the first place to hold. We'll see how it does after that. When you look at the other indices like the Russell 2000, the rally there has been poorer. This one has been better, but overall looks as though the market is now ready to go into a consolidation phase rather than either a straight down or a straight up phase. So take a bit of a breather right now.
What's going on with gold?
Well, gold had a great week here. We had been looking for a pullback into the moving averages here. We got an oversold springboard signal on our work just a week and a half ago when we were down at 3,100, and this has been a nice week. We got minimum 50% retracement rally, which is what we were looking for. Closed off the week at 33.58, so it's retraced about 60% of the decline from the all-time high into an oversold reading that we had just 5 or 6 days ago. This could very easily go back and retest the highs again. It fits part and parcel with what we see in the silver market, which now it has a decent support level at $32, and silver had a decent week here. So we'll look to see if these two markets, silver and gold, have got some upside momentum at this point. But for now, the easy part of the trade off the low, I think, is behind us. we'll just see how much upside there is. Seasonally, this is not the best time of the year for the precious metals. So a pause here and then come maybe with better upside breadth as we get into July or August might be a reasonable outlook there.
What's happening with crude?
Crude is having trouble at $64. We've been up here a couple of times now, and you look at the April rally peak there. We've seen the same thing in May. So at this point, there's some good resistance. This is also, when you look back, this was the support that we had in October, November, and again in February. So there's some overhead here right now. I don't think it's going to have the potential to move through there until we get into a better seasonal. And for now, we had a good oversold low at 55.5, but 64 is a pretty good resistance.
What's happening with the Canadian and U.S. dollars?
Well, the U.S. dollar had the rally up right to good resistance. We were looking for the 50-day moving average to present a good resistance level. That was up at 101 and change. We had come off just a great oversold low down at 97.5, and the optimum point was that rally. And it looks as though at this point, the overall trend is down, but a consolidation around the 98 level, I think, for the dollar index is very, very much what we would expect at this point. The Canadian dollar has done very well. While the U.S. dollar was rallying, Canadian pulled back. Found support at 71.5, and has managed to come right back and make new highs for the year at this point, closed at 72.96. Doing well when you look at it relative to the other commodity-related items like the oil market, which, as I say, found resistance and backed off. The CRB index is just not having much speed of an upside bias in here. So for the Canadian to do as well as it is right now, I think you've got to give it, full stars on the upside.
And number 2 on the periodic chart is number 1 in commodities right now. What's going on with uranium?
Uranium is doing exceptionally well. It came off just a great bottom. We got some big oversold signals here into the low in March, and the uranium price itself has recovered really nicely from the low 63s now into the low 73s. But when you take a look at the stocks, these have been just some of the biggest winners off the low that we saw in April for the marketplace here. On the week, most uraniums were up 11% or more. And if we take a look at it from the lows, you've got items like Cameco, which was at $35. It's now trading just shy of $59. That's just in a span of, 5 or 6 weeks here right now. And if you look across the board, got maybe a dozen names in this sector, all doing exceptionally well. So the overall looked as though it might have gotten itself a little ahead of itself a week ago, but a small pause and upside action seen again. I think at this point we can still look for a pause as a buying opportunity. Anything that pulls back marginally in that sector definitely have to be looking at as a buy and hold.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from ChartsandMarkets.com. Find him on X at Charts by Ross. Coming up, Gerald Celente next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He's speaking to us from historic Kingston, New York. Gerald, welcome back to This Week in Money.
No, thank you for having me.
Gerald, can you tell us about the latest Trends Journal and how many pages do you put on it?
You know, it averages around 200 pages, wow. And we cover everything from high-tech science to AI, technocracy, geopolitics, economics, socioeconomics. We cover the world, and I've never worked harder in my life. There's so much going on. I've been at this for 45 years, and each year we do a top trend. And this year, one of our top trends was wild card. Anything goes. You don't know what's going to be dealt. And that's what we're seeing in front of our eyes. These are the most crucial times I've ever witnessed in my lifetime. And I'm the same age as Trump. And it's like nothing we've ever seen before. And people better do all they can, we're saying, to prepare, prevail, and to prosper in these times ahead. Because, I mean, look what gold prices, look how they're spiking. Look at Bitcoin going up to, at $112 a coin. It's showing you what's going on and the fear ahead.
Moody's downgraded the U.S. credit rating from AAA to AA+. Is this a reflection of the damage done by the Biden regime?
No, it's a reflection of the damage done by the Biden, the Obama, the Bush, the Clinton, one after another. It's a freak show. They call it a government. Look around the world. Look at the clowns running the show. You look up to a little garçon like Macron over there in France, a dead in his face little jerk of nothing Starmer over there in the UK, and look at the Prime Minister before him, Boris Johnson. The best cartoonist in the world could not have come up with a better cartoon figure than him. And now you got the little warmongering Merz over there in Germany, the third largest economy in the world, in recession for 2 years. And we're going to borrow $1 trillion to build our defense up. And we're going to put some of that into infrastructure too. So what I'm just saying to you, going back to the trade debt, the debt in the country, it's one jerk after another running a show near you. And so this isn't Trump, it's not Biden, it's all of them. And building up a moronic bureaucracy. And by the way, to make this 1,000% clear, look at what the bureaucracies have done to Europe. They're so bureaucratically controlled. Oh, in the new AI high-tech world, oh, where's Europe? Oh, way down at the bottom, Europe? That's right. So this is serious what's going on. And it's not only the debt of the United States, it's China. What is it, China? Japan. Look at their debt to GDP levels, Italy. So it's just more of the same in a different country.
From February through April of this year, does it look like the Dow put in a severe correction within an ongoing bull market?
You know, what do you have? Vanguard, State Street, and BlackRock. 3 of these huge gangs, these investment gangs, own 88% of the S&P 500. All right. It's a rigged game. What do you got? 1% own 54% of all the stocks. You got put the 10% in, they own over 90%. They're rigging the thing any way they want, as much as they can, for as long as they can.
Gold hit $3,500 per ounce in April. Could this be a top for gold, or does gold look like it's going higher than that?
With the wild cards being played, we believe gold is going to go higher, probably to the 4,000 range this year. Even higher if other things happen, like Iran escalates their war against if Israel and or the United States escalate their war against Iran, you're going to see gold skyrocket.
The U.S.
There's another one too.
Yeah.
We were banned from TikTok for saying that Ukraine is going to ramp up the war against Russia. They're going to try to bomb nuclear power plants, false flags, something big, bombing oil depots, bombing deeper into Moscow. We're saying these kind of things are wild cards that could be played out that'll drive gold to new highs, because the world is getting World War III has already begun. There's going to be like a Pearl Harbor event or something like that makes it official.
The U.S. dollar topped in January of this year, pulled back into April. Are you bullish or bearish on the U.S. dollar?
Very bearish on it, and for a number of reasons. When the economy goes down, Trump is going to do everything he can to lower interest rates. And if anybody's stupid enough to believe that he doesn't have the power over Powell, grow up. Let's go back to the facts. Let's go back to 2018. December, the worst Dow since the Great Depression, 1931. What did Trump do? He pushed Powell to lower interest rates. Powell lowered them in January 2019. Oh, and the Dow went up some 22 percent. Now, let's go back to gold. The lower interest rates go, the deeper the dollar falls. The deeper the dollar falls, the higher gold prices go up. Much of the world has had enough of the United States' geopolitical and socioeconomic hegemony. They're going to get off the buck as much as they can and do everything to kill it and have another currency to go to. And now, with the debt level increasing, and depending on whose numbers you look at, the real debt level is between 100 to 200 trillion, not almost 37 trillion, when you put Social Security, all the other government payments that are coming out. So when you look at that, you look at the fear of the government borrowing more money to pay the debt, and what is the interest now? Like $1 trillion a year just on interest payments? So the dollar's going down. And I want to make this 1,000,000% clear. America has become the country that the founding fathers fought against. The UK, Great Britain, where the sun never sets on the British Empire, and these royal family, if they were Italian, they'd call them a mafia, invading countries all over the world, killing, they say in India, for the occupation for almost 100 years, they killed over 400 million people from India for various reasons in different ways. We became that country in wasting our money fighting wars. And what happened to the UK? After World War I, the pound died. Welcome to America. All our wars, rather than the money going in like with China, for infrastructure and for the country, our money's gone to the military-industrial complex. So we have taken the path of the UK because of all the wars the United States keeps fighting, and for all the money that they put into these wars, it's bringing down the value of the dollar. And so that's what's going on. The death of the dollar has begun.
Crude has been pulling back. Where do we go to from here?
It's going to keep going lower as you're seeing OPEC Plus, just month after month, putting out more supply than demand because they need the dough. The only thing that's going to bring prices up again is if the United States and or Israel go to war against Iran. Then you'll see Brent crude go from like the $64 per gallon range that we're talking now, or per barrel range, that could go up double to 120 plus a barrel. And that'll crash equity markets and the global economy.
Inflation and interest rates, what do you see ahead there?
Again, lower interest rates and more inflation. They're going to do everything they can to keep propping up the economy. And they got look what's going on with new homes with home sales in the United States. In April, they hit the low of 2009, the Great Recession, because your interest rates are so high. So they're going to do what they can to keep lowering them. And again, the lower they go, the deeper the dollar falls and the higher gold prices rise.
Bitcoin's over $100,000 US dollars, nothing backing it. Why do you think people are paying these prices for Bitcoin?
We called Bitcoin. We were late on it. We only started in 2017 saying it was the future. It's a digital world, and this is part of it. Like it, don't like it, whatever it is. And by the way, if there wasn't a Bitcoin, you'd see gold prices probably almost double their price now, and all the other cryptocurrencies. You're going to start seeing central banks going into CBDCs, digital currencies. Go to China. Nobody pays with money anymore. It's all digital. And matter of fact, they may come up with a new digital currency and say this new digital currency is worth X amount of dollars, and they'll use that as an excuse to bring down the debt level they have, because now they're saying this new digital dollar is worth much more than the dirty cash that they trashed out. So that's the kind of thing you could see going up. The other thing we said why it was going to go up is the Trump clubs and the crypto club. The crypto gang gave him, over $100 million for his campaign and his inauguration, plus. And they're all in the show. His son's in the show. That guy Lutnick, the Commerce Secretary's son's in the show. So they're going to do everything they can to keep pumping the price up, to keep making more money. The gang is running the show in front of everybody's eyes.
In the first 4 months of President Trump's presidency, what has he done right, and what does he need to work on?
Well, I approve, by the way, again, we're political atheists. I'm totally disgusted with Trump's support of genocide in Gaza. He came out against what he called genocide in South Africa. Yeah, how about that? Where's your mouth for the other thing? And that the United States keeps supplying the weapons of death. So I can't stand him on that level. I'm going to end the war, that Ukraine war, in 24 hours, all right? Hey, got son, you didn't end it in 24 hours. Hey, when I get elected now, it's going to end before I take office. Hey, the war's still going on, So, he talks out of, 10 sides of his mouth. I agree with him on the tariffs. Again, America used to have manufacturing here, and slime balls like Bill Clinton with NAFTA. Get the manufacturing, these dirty jobs out of America. Bring them to Mexico where you can make more money, all right? Brought China into the World Trade Organization. So I believe, and then again, we wrote in the Trends Journal a couple of weeks ago that Apple was moving its chip development to India. And we said, how come they're moving it out of China? How come they're not moving it to America? And now Trump is now saying what we said 3 weeks ago. Hey, how come you're doing? So he's putting a tariff on them. So I agree with the tariffs. And you need to bring manufacturing back, because all we have are low-paying slavelandia service sector jobs. And again, we'll only go by the numbers. You look at the employment increases, they're in the healthcare sector and retail and service sector. They're low-paying jobs. When you had manufacturing in this country, you had a middle class. And I agree with him about getting rid of all these stupid government jobs that they have. The bureaucrats are the lowest pieces of crap on the planet. These are scum that can't get a job in the real world, that suck into the political system and become the most arrogant. Not all of them, just about 99% of them. So I can't stand that stuff. So I totally support him on that. But again, I told you what I don't support him on.
Are tariffs a good way to bring manufacturing back to the U.S. and stimulate the American economy?
In theory, yes. As I said, I believe so. But again, you're seeing a decline in America where the country's going down so strongly. Do people really even want to do those kind of jobs anymore? And how many will? And the other thing, too, is important. He's bringing foreign countries into the country to manufacture the product, which is different than the American countries manufacturing the product. So I don't know how successful it would be, but again, I do approve of it, because it was a different country before China came into the World Trade Organization, and Mexico was brought into NAFTA, and on and on. And by the way, this is very important. With trend forecasting, you make connections between different fields. Before China was brought into the World Trade Organization in 2000, 10% of its 18-year-olds went to college. Today, nearly 70% go to college. Why is this important? AI. Let's go back to January. Nobody heard of DeepSeek before. All of a sudden, they appeared. Oh, DeepSeek, that high-tech AI company, that you could do it for $6 million, not $100 million, and we don't need these big NVIDIA chips. So it's the future is AI. Young people are totally AI, high-tech addicted, and you go by the numbers. China got 1.4 billion people. America got 347 million. And you got all these kids going to college, while the college rates in the United States are going down. And you see all these cities, by the way, that are college cities that are going bust because the enrollment's going way down. So China's going to lead in AI, and that's going to bring a dot-com bust in the United States because they overinvested in the new companies that began AI. Trends are born, they grow, they mature, they reach old age, and they die. AI was only born in 2022. It's an infant. You don't invest in the infant all your dough. So that's very important because there's going to be a dot-com bust, and we call the dot-com bust, this is going to be dot-com bust 2.0. You go back to your Trends Journal, when it was a quarterly, now it's a weekly. Fall edition, 1999, we said there would be a dot-com bust by the second quarter of 2000, and it did. It busted in March of 2000.
Is real estate in trouble?
Commercial real estate, particularly, it's going down from all sectors, just about, from the retail sector, and the big one's going to be the office vacancies. You got a city like Portland, Oregon, that was booming before the COVID war, before they locked down everything, and now you have a 35% office vacancy rate, homeless and drug dealers all over the place, and people emptying the big buildings. And that's only just part of it. There's going to be defaults on these banks' loans because when the COVID war began 5 years ago and people started working from home, you know, they didn't kill their leases right away because they're 5 and 10 year leases. Now those leases are coming due, and they're not going to be renewed fully. So there's going to be a lot of failures of office building loans. So that's something very important to watch that nobody's talking about other than the Trends Journal.
We're hearing the greed of private equity is destroying the economy. What are you hearing?
It is. Again, private equity. I mean, you got, as I said, you got Vanguard, State Street, and BlackRock own 88% of the S&P 500. Once upon a time, there was this guy by the name of Mussolini, and he said corporatism is the merger of state and corporate powers. And that's what you got right now. They're running the show. And it's disgusting. Again, there's articles in your Trends Journal about how the rich keep getting richer, the billionaires get billions and billions more, and the middle class keeps shrinking. We didn't have, when I was a young guy, we didn't have these things. There was no private equity groups, venture capitalists. Once upon a time also, there was this thing called off with their heads. Yeah, I wonder why that happened. Blow me away. Same thing's happening now. And they don't put a penny for peace. I launched Occupy Peace over a decade ago. Warren Buffett's son, Peter Buffett, was one of my tenants in the 1773 Dr. Jensen house in Kingston. Never gave me a penny for peace. He only came to one rally when Ralph Nader was here. Where were the billionaires? Don't have a penny for peace, not a penny for a renaissance. You know, all they were are selfish, greedy slobs with bad attitudes, as I say it. Look at the Carnegies. Look at the beautiful library system that they built. They gave back at some point. They don't give anything. All they give is a lot of loudmouth crap of what they're doing.
President Trump continues to talk about Canada becoming the 51st state. Canada has a new Prime Minister, Mark Carney. We're hearing he's high up in the World Economic Forum and has ties to the Communist Party in China. Carney just bragged that Canada sends the most money per capita to Ukraine. Now some Canadians are talking about wanting to become the 51st state. Could there be a North American revolution ahead?
No way. Yeah, Carney's just another clown. Again, as I said, look around the world. It's a freak show, and the freaks are running the show. Gutless little boys, by the way. If you call them out man to man, you know, they fold like that. You know, a bunch of jerks. You got this guy, what is it, Randy Fine or somebody down in Florida? the other day, said we should do to Gaza what we did to Japan, bomb them with a nuclear bomb. Look at the arrogant little slob of a jerk saying that stuff. Oh, you mean you killed all those innocent people in Nagasaki and Hiroshima when the war was actually ended? I mean, I'm telling you, when are people going to grow up and stop swallowing the crap coming out of politicians' mouths? To me, the only way to go is the Swiss way, direct democracy. Let the people vote. You want to go to war? Let the people vote. You want to do this, that, or this? Let the people vote, rather than the politicians who get paid off. Look at that Carney clown. He was a member of the money gang for how long before he got into this gig?
On Tuesday, King Charles III will be in Canada to read the government's throne speech. Is this likely to show support for Mark Carney?
Yeah, I don't know. Look at a clown dressed up in a costume with a little stupid hat on. Again, if they were Italian, you'd call them a mafia, royal family. Who made up this royal crap? You mean a gang that stuck together and robbed and killed and stole everything they wanted? And don't forget to bow down when you see them and roll out the red carpet. Look at that little jerk. Again, they're a mafia. And they're all bad. It won't make any difference. It'll come and go. It won't make a bit of difference.
In Canada, the mainstream media is looking for more government handouts from Prime Minister Carney, with audiences diminishing as more and more people wake up. Do you think there will be pressure to make propaganda illegal again?
Again, the government money, they're prostitutes. They're media whores that get paid to put out by the corporate pimps and government whoremasters. I used to be on Oprah, the Today Show, Good Morning America, Fox, you name it. I used to be on everybody all the time. When I came out against the wars, I was blacklisted. Not one person out there, not one person on any of the major media talking about peace on earth. Nothing. Makes no difference. There's no media left. Go to the New York Times. They call themselves the paper record. I call them the toilet paper record. Pick up the Sunday edition for $6. Whole front page. Page after page, section after section, filled up with a big stupid picture. Go to the Wall Street Journal. Look at the big stupid pictures in the front. They used to have journalism. They didn't have pictures everywhere. Journalism is dead. What we're giving the people with the Trends Journal is no magazine like it. We're journalists. We put down facts. Nobody tells us what to say. No ads. No ads. We don't get paid off. And it's $2.59 a week. The Wall Street Journal, we hardly get an article from it that's trend-worthy anymore. But we have to read all this stuff. $5 a day. Now, journalism is gone. Here, now that slimeball, Bill Clinton, Federal Communications Act, 1996. There were thousands of independent radio stations, newspapers, television stations in America before that. Now 6 companies control 92% of all the media, okay?
Awareness of organized crime, drugs, and money laundering is growing. Do you think organized crime should be worried?
No. You mean the government's organized crime? I mean, look what they did during the COVID time. You don't get the jib, you don't get a job. All right? It's one big club. Whether it's just a different one gang they make legal, the other gang they make illegal. The gangs will persist in either side.
Do you think Big Pharma's days are numbered?
No, they're not. I very much support, by the way, what RFK Jr. is doing. The first book I worked on, by the way, back in the 1980s was called Natural Healing, Dr. Jack Saltinoff, a Warner book. I'm very, I agree with a number of things that he's doing. Totally opposed to Kennedy on his pro-genocide side. So I think there is positive movements going on there.
Information is coming out that Joe Biden wasn't able to function when he was president and wasn't well enough to really run the country. Are we likely to see numerous treason charges ahead?
No, there won't be any treason charges ahead. But who in their right mind couldn't see that Biden was dead in front of you anyway? They got to wait till it makes it official.
China has infiltrated the Western world. Is China working on infiltrating other parts of the world?
How are they? I don't know if you call it infiltrating. I mean, they're doing business. As we said, the business of China's business and the business of America's war. And that's why China keeps expanding. And China's building up its military big time, their naval fleet. and they're building up more and more trade agreements with Latin America, South America, and Asia. So China's going to do everything they can to keep building up economically. As the war goes, I don't think they want one or will do one unless they're forced into one.
Do you think the market for electric vehicles will continue to grow?
Yes, the market for electric vehicles will continue to grow, particularly as they come up with more advanced batteries, which are happening. I mean, now you have re-electrifying the cars in 4 to 5 minutes. So yeah, it's going to keep growing slowly in America, but obviously it's a big deal in China, and that's 1.4 billion people. It's going to keep expanding in Europe as more and more of these laws keep going into place as well. So yeah, the future it's not only the future electric. I mean, there was a guy by the name of Dwight D. Eisenhower, 5-star president, supreme commander of the Allied forces and 2-term president, and warned the American people that the military-industrial complex was robbing the nation of the genius of the scientists, the sweat of the laborers, and the future of the children. I mention this because suppose rather than putting now almost $1 trillion into defense, they, as Eisenhower said, robbing the nation of the genius of the scientists. Could you imagine if they put the scientists' brains not into weaponry, but into new energy? You'd go way beyond where we are now. So trends are born, they grow, they mature, reach old age, and die. The new switch to EV and beyond is really still in its early growth stage.
Is the state of the luxury industry an indicator for the economy?
Absolutely. The fish rots from the head down. And again, you have to put all the trends together. China was booming, and they killed their economy when they launched the COVID war in January 2020 on the Year of the Rat, their Chinese Lunar New Year. They locked down the country for 3 years of zero COVID policy. They destroyed the lives and livelihoods of hundreds of millions of people. And they have a very, very serious economic issue with their overbuilt sector of real estate. Depending on whose numbers you look at, you're looking at 60 to 90 million vacant buildings. So there's going to be an up and a down. And overall, we see the global economy going down. And we see, again, the facts are all there. All the data is coming out. Very few countries are advancing economically. Everything was artificially propped up with the COVID war, with all the zero interest rate policy and trillions of dollars of cheap money backed by nothing and printed on nothing, dumped into the markets.
Comedian Ron White says you can't fix stupid. Do too many stupid people put societies at risk?
It's been like that forever. Look, you want to see stupid? How about looking at one of the stupidest little jerks that was president of the United States, a little boy of nothing, a spoiled little daddy's boy, George W. Bush, a cartoon figure. We're going to get that guy Osama bin Laden dead or alive. 90% of the people swallow the crap spewing out of his mouth in America, all right? Stupidity is the way. Facts don't matter to people. They know more about did Taylor Swift have sex last night? They don't know anything of what's going on. They know all the sports, all this. When I was a young guy, I started learning things, and I get upset about, Dad, why won't people see this? And my father, may rest in peace, he looked at me, he said, son, take it easy. People have little minds. And if you don't believe me, look at the crap people eat because of what they're advertised. Again, look how they follow their leaders. Look how they do what they're told when a celebrity tells them. And that's another stupid word, a celebrity. Yeah, ramping up a little clown boy like a Bruce Springsteen. Oh, you don't get a vaccination. You can't come into and hear me play and spend a lot of money to hear me. All right? It's a freak show. It's celebrities. Nah, the people follow the masses. And but again, it does not take a majority to prevail, but rather an irate, tireless minority, keen on setting brush fires of freedom in the minds of men, said Samuel Adams, one of the founding fathers of America's revolution. And that's what has to happen. But you can't do it without money. And so the people with money have to unite to make that happen if they want to bring back civilization to a higher level.
Gerald, how can people subscribe to the Trends Journal?
No, just go to trendsjournal.com, trendsjournal.com. We're giving the people history before it happens. You know, we're talking about the high prices of gold. What was one of our top trends for 2024? Oh, a golden year for gold. That only went up almost 30%. Again, we're giving people what they can't get anywhere else for the grand total of $2.59 a week, and you could get a monthly too. And you don't like it, 30-day money-back guarantee. So trendsjournal.com, trendsjournal.com. And the more subscribers we have, the more people will be informed, and the better the future of America will be when the people that know what's going on do something in a positive way to change it in a positive way.
Gerald, thank you so much for being on This Week in Money.
And thank you for all you're doing, and thank you for having me on.
My guest has been Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He was speaking to us from historic Kingston, New York. Coming up, David Skarica, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is David Skarica, author of the book Mega Returns, Profit from Maximum Pessimism. His website, profitfrompessimism.com. He's speaking to us from the Bahamas. Dave, welcome back to This Week in Money.
Yeah, it's great to be here again, and I hope you're doing great, man.
Well, David, I have a copy of your 206-page book, Mega Returns, Profit from Maximum Pessimism. Can you tell us a bit about this new book and where people can buy it?
No, so it's available in two areas. On Newsmax.com, I think it's Newsmax.com/mega, if I'm correct. I'll give you the proper link if that's wrong. And you can get the book actually for free, and then you get a discount. I write for something called Financial Intelligence Report. I've written for it actually since 2009, so almost 16 years. And I think you get the newsletter for 40% off. It's only $110. You get it for $65, and the book costs $30 or $35. So really, you're just getting the book for free and only paying, or whatever, getting the book for what it's worth, plus only paying an extra $30 for the newsletter for a year. Or you can just do the regular route and get it off Amazon, where I think it retails for about $30 US and about 45 Canadian. So that's where you can get it. They sold out of the first tranche pretty quick on Amazon. I was doing a lot of interviews on Newsmax, but I think they've reloaded them, so you shouldn't have a problem getting a copy. So, and actually, what's interesting is, as we get into this interview, a lot of the things that I talk about the book, the stock market being overvalued, a potential issue in the bond market, bull market in gold and silver, other commodities, and is actually starting to play out in the last few months as the book has been published.
Yeah, I mean, just flipping it open here, you're talking about Elon Musk, Doge, and so on. So this is a very, very current book, and the title couldn't be better: Profit from Maximum Pessimism.
Well, with the thing with the Musk and Doge, I kind of snuck that in because I have a whole chapter on the problem of bonds and problem in the bond market and all this sort of thing. I have a whole chapter, and then I also have a chapter, obviously the government debt problem. And then Musk kind of came out with Doge early on in the Trump administration. So my book kept getting pushed back. Like the original date was January, and then when the Doge thing came out, I was able to sneak that in kind of right before the final print and first edition of the book, which obviously came out in April. So yeah, it's like the thing about Doge, which is interesting if you want to get in the government debt, is I think it exposed like a lot of the ridiculousness that we all know goes on in government, and I'm just making things up, but this is like the kind of thing they found, I don't know, like transgender studies in Chad in Africa, right? And $10 million goes towards it. And I almost think those things are kind of like scams. Like, who actually works for that? Are you ever going to meet anyone in your life that actually works for that? And it's almost like that's the way maybe of laundering money to somebody or something, like, so it did show that. But look, all he's cut is $25 billion or so of the non-discretionary budget. So what people don't know is what non-discretionary spending is. There's about $2 trillion of it in the U.S. That comes outside of Medicaid, Social Security, and Medicare, and interest on the debt and defense. So $2 trillion of the $7 trillion budget is that. So they've cut about $25 billion of that $2 trillion. The problem is, especially with the baby boomers aging and obviously higher interest rates, things like interest and all those social programs are increasing at much higher rates. Like the deficit this year is going to be probably closer to $2.5 trillion after being $2 trillion last year. So it's not like government spending is really being cut. And we saw in that last budget, there's almost no recommendations from DOGE. So people can say, when Elon Musk went in, and I've seen people tell me this, like, the courts, like, they'll blame left-wing judges or something for overturning a lot of the cuts, and there's some truth to that. But my big rebuttal is, I think the real major issue is Congress doesn't want to get rid of any of that, waste and whatnot, because they're almost like, the guys in Congress are almost like pigs at the trough, and they benefit from all of that, and a lot of that money is kicked back to the donors. So I don't think until you get a real debt crisis, we're going to see anything really change,
Which sectors are you currently seeing pessimism in?
Well, it's not so much sectors because the market itself is so overvalued. Like I talk about in the book, Warren Buffett's favorite indicator, market cap to GDP, hit 210%, which was the highest level ever, even higher than the late 2021 peak in stocks. So much of the market is overvalued, but there's always like little isolated companies. Like right now I own this financial publishing company that trades 4 or 5 times earnings and yields like 6%. And actually it was trading at 3 times earnings and yielded like 8% when I bought it because it's gone up in price. So, obviously the valuation, but still very cheap company. And then, I'm looking at a potash company right now that's very cheap. And I also bought a couple small tech companies that are really beaten up. So it's more like isolated things, and actually, I think the gold and silver juniors, because even though we've had this big move in gold and silver, they're still very cheap. Like one junior, I just did a bunch in at 5 cents. A lot of these things I can't mention, right, because they're for paying subscribers. But it's right now this stock is so sign up and pay, and you'll learn what it is. It's trading at 50 cents per ounce of silver in the ground, and they actually have a small gold resource on top of that. And gold resource essentially you're buying for free because the company only has a $6 million Canadian market cap. So I didn't mind. I did actually a larger private placement than I usually do in this thing because, again, I don't really see the downside. And that's the one thing about maximum pessimism is what you have to ask yourself when you're buying is, can this thing, what's the downside to the upside? And Doug Casey also used to have a great saying I loved, which said, I'd rather bet a dime to make a dollar, not the other way around. And that's the way I view these companies, that if, I used, like one of these companies recently I was stopped out on and had a small loss in it. And it's like, okay, I don't mind if I can lose 10, 15, 20% on a trade, so be it. That's going to happen in the markets. But when these companies turn around, like you can make 100, 200, 500%. Like one stock I don't mind mentioning is one of my favorite holdings or largest silver holdings has been Avino Silver, ASM, both on Toronto and NYSE. And this stock has had great production, great profits, really taken off and gone from $1 to $3. And because it was like fundamentally very undervalued. And that's the kind of thing I'm looking for. And then at $1 again, where was the downside? I also own Endeavor Silver, which has been about a double for me. And same thing, actually one of the things I used, it wasn't a complicated metric. It was just a ratio of Endeavored Silver divided by the price of silver. And even though Endeavored Silver had been lower in the past, about a year ago when I bought it, when you took it and divided by the price of silver, because silver was in the low 20s, the ratio of Endeavor Silver to the silver price was the lowest it had ever been. So it was telling me that just from that simple metric that Endeavor Silver was very cheap, and the stock, like I said, has more than doubled in a year. So usually what I'm looking for is I'm looking for a 2 to 4 year time frame, and I'm looking to make 3 to 5x on my money in these kind of deals. I actually, another stock that I own, so I don't mind talking about it because I've sold it, was Fubo, which is a streaming service. So, and this was kind of like a classic trade in this pessimism. So what I did was, I was buying it around between 130 and 150 for a year or two, and it was just sitting there, but they were trading at a quarter of their revenues. They did have a little bit of debt on the balance sheet, but they're growing the top line by 20%. And they had a lawsuit because Fubo really does a lot in streaming sports, and they were trying to get what was called a skinny sports package. So they were trying to get a streaming service through the big guys, Fox, ESPN, etc., to basically just stream soccer, football, basketball, etc., and at a cheaper price. Because I have like the $100 a month service in Fubo, and they were trying to get that sports package would be like $40-$50. And those companies kept saying no, and then those companies got together and started their own service called Venue, and even their logo looked like the Fubo, a ripoff of the Fubo model. So Fubo sued them, did an antitrust lawsuit, and I was like, I think I have a really good chance of winning this lawsuit. And they settled basically out of court, and then Disney gave Fubo a whole bunch of money, and the stock went from $150 to $6. I think it's around $350 now. And so again, at $150 with all these catalysts, and they're growing their business, and it being a cheap stock, and it had fallen from $60 a share, I think it roughly was its high, to $150. I didn't really see the downside, and then, like I said, it ended up going up 3 or 4x, and I had stock options on it that went up, I think, nearly 5x. So that's the kind of thing I look at in the profit from pessimism, and I think that's also a really key element to it. It's not just, buying an asset that's undervalued and cheap or whatever, because a lot of things can stay undervalued for a long time. You need a catalyst to kind of turn around the business, and the trade I always talk about, which was a classic trade, was John Templeton, I talk about in the book too, bought 100 stocks under $1 in the 1930s, because he saw that the catalyst to turn around these companies was the war, because the U.S. was going to be supplying, basically the Allies, and that would turn around the economy because there'd be more industrial production. They're going to be building armaments, and actually a lot of the companies he bought were actually railroads, because the railroads were basically bankrupt. Because the Great Depression and a sluggish economy. And he was like, well, a lot of these are now going to start making money because they're going to have to, they're going to be making guns and tanks in Kansas City or St. Louis and then shipping them out to the coast before they ship them to Europe. So that was kind of his philosophy towards it. And he ended up turning $10,000 in those 100 companies into $100,000 in the next 4 years, which really vastly outperformed the market. And, if you take that in today's money, probably that 10,000 is a couple $100,000, and he turned that into basically 2 million. So that's kind of like the basis of the trade. Is I think one thing that people don't get just when they're value investors is you need a potential for a turnaround, and also because I know some people will call it value investing, where I think it is it's different as well. Is I own Altria, Philip Morris, which was Philip Morris, MO, the ticker. I don't even look at it. Something I've owned for a few years now. It pays a 9% dividend. That's just a value stock, but it's not beaten up and cheap. So there's a difference between buying something beaten up and cheap and something that's a value stock that just may pay a dividend and make you a good return every year.
How tough is it to identify pessimism and undervaluation versus bubbles with overvaluation?
It's really difficult because and Peter Gundlach has said this as well. When I got interested in the markets, it was a book called Bankruptcy 1995, written by, I think it's Eddie Figge or Howard Figge. I can't remember, but it's Figge was his last name. And it was published in 93, and this is why it became kind of a gold bug, because he talked about how, the government essentially was going to go bankrupt, and when the government went bankrupt, you would want to buy these you buy these assets, right? So when the government bankrupt, you want to buy gold, silver, and then the debt would all go down, etc. And I think this is finally starting to happen, especially you see what's happening in the bond market today. And Figge basically was wrong by 30 years. And everything he said was right. The amount of debt that would accumulate over the next 30 years, all these things, they were correct. But they use all these financial shenanigans with quantitative easing and printing of money to suppress bond yields, and all these kind of things happened, and made it take a lot longer than expected. Look at Japan. Japan looks like they might be finally in the early stages of a bond market debt crisis. But again, Japan has 260% debt to GDP. They've been the most indebted country in the world for decades, and now it looks like this is finally coming to fruition. So these things can shake forever. So being a value investor, I know it's been tough for me because I thought the market started, I got bullish in the market in 2009 near the bottom, but then I thought like in 2014, 2015, it was getting overvalued. And by most historical measures, it has been, but it's had 10 years of overvaluation. Just like if you were a value investor in the 70s, the market was basically undervalued from like the early 70s to early 80s, so it was 10 years of undervaluation. So it's like it just can take longer than you think, and the tops are always more difficult, especially now because, with so many more pension funds and other vested interest in the market. There's a big vested interest to have the market go up forever. And I do think, by the way, even after the market has some kind of smash or bear market, I don't know what's going to happen after that because I think that will lead to a recession and debt crisis, and they're going to print so much money during that debt crisis to bail everything out that the Dow may go to new all-time highs in nominal terms. Because if you look at Argentina or Turkey or these countries that have hyperinflations, the stocks actually, along with gold and commodities, hold up very well because they're a inflation hedge.
2024 was a record year for stock markets. Are there indicators the stock markets could go even higher?
Well, see, here's the thing: is that there have been a bunch of. I kind of got short-term bullish. When that market smash happened, because I don't know, it was almost like an artificial decline because that decline really was due to all the tariff announcements, which kind of shocked everyone and were much more aggressive than I think people thought, even the people that were thought that Trump was a trade hawk, right? So, but then they've kind of loosened it. Of course, now today they were talking on the 23rd of May. It's kind of changed because Trump kind of did a 180 on the EU. But what I'm trying to say is that was like an artificial decline, and now we're kind of just back up to the kind of mid to higher end of the range in equities because of that. So, but a lot of indicators, like a guy used Martin Swag, one of his indicators was called double barrel days. So it's basically 2 days within a couple month period where you got 9-to-1 up volume on the S&P or the NYSE, which has happened. And usually those days lead to higher prices for 3, 6, 9 months. So who knows? Maybe if Trump backs down on the tariffs and you do have some short term, momentum from the tax cuts, maybe the market can continue to rally here. But I'm very, very, apprehensive. The bond market really scares me. I do think we're in an economic slowdown. And you have to look at the big picture macro of all this is, I think, and I'm name dropping like crazy this episode, but I was also, one of my mentors was Jim Dines, and he had a thing he called Dinopa. And Dinopa was basically like kind of irony, like when you do one thing and it blows up in your face. I guess you could say irony or catch-22. And I think actually all this talk and things that Trump are trying to do, I personally believe are going to lead to less investment because companies that are investing hundreds of billions or trillions of dollars are going to be like, we don't know when this guy is going to wake up. Basically, I hate to be so vulgar, but I will be, like a bad smelling dump at 3 a.m. and then get all angry and then do a tweet, So it's not the way you can run an economy, in my opinion. And right now, all these countries can say, oh, we're going to invest this or we're going to invest that. If you go look at the amount of money that the Middle Eastern countries, when he was just there, were talking about investing, it's totally unrealistic, in my opinion. They're not going to invest that money. Right, they're just doing that to appease him in the short term. And like I said, like a car company is going to be like, well, we don't know when this guy's going to change his mind. You look at Europe. We're supposed to be in the 90-day tariff thing, and now he's talking about doing 50% tariffs June 1st. So I don't think you can negotiate with something like that. And I think many companies are going to be reluctant to invest. And a lot of times, too, is look at, this isn't China, right? You don't have a dictator for life. Basically he's done in 2028. So a lot of companies at this point are going to be like, we got 3 years and more of this, and maybe we'll just wait out the 3 years and just see what happens after that.
How important is it to look for stocks with low debt?
That actually can be a mixed bag. Obviously, you want companies with strong balance sheets, and part of the reason when I'm looking at Pessimism plays, I'll give you another example of a stock, was I first bought Athabasca, and actually I'll give you a stock that sometimes you can sell too early. Athabasca Oil, ATH.TO, I recommended that in the letter at 10 cents, and we sold it at 50, and I thought it was a genius because I looked at his balance sheet. And this was in 2020, when oil collapsed. And I was like, you know what? They can probably outlast these oil companies or low oil prices for 2-3 years. And I think oil will turn up before then, so they're not going to go under, because their balance sheet was like pretty strong. And anyhow, now it trades at $5. And actually, I repurchased it at $3 and then sold it at $5. So again, so sometimes a strong balance sheet can be, you want to, because the company needs to be able to survive. But sometimes a weak indebted balance sheet can actually help a company, because if you can get that turnaround, right, that makes them more leveraged. Like, one reason maybe one of these stocks will go down 99.9% is because it looks like they may go bankrupt. And then if things all of a sudden turn around the sector they're in or the business that they're in, like they can like turn everything around, and because they had all that debt and people were pricing in bankruptcy, then they can turn around. Actually, the weakest companies in that Templeton trade, the companies that were most indebted back in the 30s, they were the ones that went up the most. Like the strong ones went up like 2-3 times during that trade, and some of those weak ones you owned went up 10, 20, 50 times. So it's a mixed bag on debt, because if you have too much debt, you can go bankrupt, obviously. But on the other hand, if a company is highly indebted and everything's timed right and they can turn around, that's why with plays like that, I might just put a little bit of money in it, hold my nose, and say, okay, well, if this does turn around, I'm going to make a lot of money on this trade,
The VIX, the volatility index, would you buy straddles when the VIX gets back into the mid-teens? And what are straddles?
Well, straddles are basically an option. I talk about this in the book as well, and obviously that's why you asked me the question, but are basically buying a put and a call. So basically roughly the same price, or maybe like you buy a call, both of them are 10% out of the money. And what you just need by doing that is, obviously the VIX is lower, means the premiums and puts are lower. So you don't want to buy a straddle when the VIX is 60, right? Because you're going to be paying up for the cost of those options. But if you buy a straddle and the stock has a big move in either way, you can make a lot of money. Like the example I used in the book was one of my favorite trading stocks used to be Sotheby's. The ticker was BID. Obviously all the auctions, like auctions off expensive art and that sort of thing. And Sotheby's, and obviously they own the real estate company too, and they sell high-end real estate. So obviously very, very economically sensitive companies, very sensitive to asset prices. So it would go to like $5 during all these crashes, like in 2008 or 2000, and then it would go up to like $60 in all these bubbles. So it was a great like risk on, risk off trade. And the example I made though is that Sotheby's got taken out years ago, and if you would have had a straddle, the calls on the company went up like 6 or 7 times. The puts would have expired worthless, but that means the equal straddle, you would have made 3 times on your money. I don't think anyone can complain about that. So, and like another example I use is this year's Microsoft went down about 30% during the first 4 months of the year, and then is up 30% in the last 4 months. So again, if you would have had a straddle in Microsoft, you would have made money on the puts in the first 4 months, and then you would have made money on the calls the last month, if your straddles were far enough out in terms of time frame. So, and again, but I would only put them on when the VIX is low, because people don't realize the VIX is just volatility prices of options, and it's not just puts. It's like when there's volatility spikes, people pay more for all this stuff, and you don't want to buy the VIX when it was 60 like a month ago, because you're going to be paying too much premium. And just look at it this way, if the VIX goes to 15 from 60, all of a sudden that premium is down by 75%. So, your option price can go down 75%, even if the price of the stock doesn't move. So you definitely do not buy those things. Other than if you're doing stuff like shorting the options, like shorting the puts, or like writing calls or puts, which is much more sophisticated. I really don't get into that.
Gold versus the S&P 500 was cheap from 2020 through the fourth quarter of 2024. Is this a case of the longer the base, the more space?
Yeah, I think like with gold, it's an interesting trade in the last 30 years, because one thing I admit my mistakes that I was wrong about when I had my previous book, The Great Super Cycle, out, was I was right about, if you go look at it, like gold and silver now have come up. And I also said that bonds would top out during this area of low interest rates and zero rates. And if you go look at like 10-year yields in the U.S., they're like near 20-year highs, right? So and then I said this stuff will all cause inflation, which it has. But the thing about gold was, what it looks like to me is we're in a mega cycle that began in 1999 to 2001. when gold bottomed around 250 to 350. And we had this big first run up into 2011 from gold from 250 to 1900. And then we had this like consolidation, and then gold went down to about 1100 or 1050, I think was the low. And then went from 1050 and about 1400. And so anyhow, and then gold kind of broke out, went back to the 2000s and in 2020, and then now kind of pulled back, and now is breaking out again. So it almost looks to me like this is the second leg of a mega bull market in gold. Now we have this 10-year uptrend, and then an early 10-year kind of consolidation, and let's say we have another 10-year uptrend. It'll probably last into 2030 or so, right? And where gold usually ends, and I talk about this all the time too, is the last two major tops in gold, which would have been compared to the stock market, which would have been 1932, because the stock market collapsed so much and gold was just pegged, or 1980, because of high inflation, and again, the stock market gone nowhere for years and gold went up a lot. It's about 1-to-1, right? So right now the Dow's 40,000, say roughly, and gold is 3,000. So we're say it right now we're roughly 13-to-1. So we're still nowhere close to that. It probably will meet in the middle, like gold, like stock market, have some kind of like bear market, and maybe they meet at 20 or 25,000. And one thing that too you have to understand about gold, where I think it is kind of different right now, and it's always dangerous to say I understand this time it's different, but we've never seen this much debt before in the system. Private debt, the government debt in the U.S. is 130 or 125% of GDP, on its way to 140 probably in the next 2 to 3 years. And remember, the debt to GDP was only 30 or 40% in the late 70s during that inflation. So I tell people that. So imagine, you think gold went from 35 to 800, what it can do now when the debt levels percentage of GDP are 4 to 5 times higher than where they were in 1980.
Gold stocks remain boxed in. Is the Barron's Gold Mining Index below 1,000 considered a buying level?
Yeah. What's interesting about gold stocks, just so you know, is as opposing to gold, since the early 2000s now, we've gotten to the point since 2004, so roughly the last 20 years, even including dividends in the S&P, gold has actually outperformed the S&P now for a 20-year period. So, but gold stocks have been kind of miserable since about the 2006 to 2011 period, and they're not the greatest companies. So many things can go wrong. You're dealing with, you could be in an area where politically, maybe the country decides to nationalize mining, or you can have a rock fall at the mine, or your grades can end up being lower than you initially thought. You can take over properties that looked profitable. This is what happened a lot in 2011. It looked great at 1,800 gold, and not so good at $1,000 gold with rising costs, 5 years later, right? So there's so many bad things that can happen. So I view gold stocks as more of a trade. You want to buy them when they're cheap. You want to buy that Barron's Gold stock index under a certain level and then sell it over another level. I do think now, and it really started in February of last year, we're in one of these at least 3 to 5 year periods. I mentioned maybe we go higher into 2030. So maybe we have another 5 years left of this, right? Which would make this more of a 6-year move, because it started in 2024. And, the 2000 basically to that bull market in gold stocks really lasted 10 years. Because after the crash in 28, when gold stocks fell with everything, they came back very strong and hit the first sector hitting new highs. So I think because the stocks are so cheap, especially a lot of these gold stocks that I own, which have done well, they're actually starting to, report good cash flows. One of their biggest input costs is energy. And oil and those costs are basically stagnant. The big wage gains we saw post-COVID are kind of stagnant now too. So I think that the gold stocks are going to continue to see kind of strong fundamentals, cash flows, profits, and a lot of them just were getting rid of debt and that sort of thing in the last a few years. So a lot of them have not increased production. So I think you'll see more M&A in the sector, which will really help as well. This is why I kind of like the smaller mid-tiers that say are just 1 or 2 property companies that say have another property too coming online, because you have the double, barrel positive of where you're going to see increasing prices in the metal that they sell, right? And then also you'll see the production go up. So if someone's, for example, a gold stock goes from, I don't know, 1 million ounces a year in production to 5, plus the gold price triples. Just do the basic math on that and the leverage that you'll get, especially if that company is basically like, cheap going into that.
The GDX and the GDXJ market caps remain low at $14 and $15 billion. Is this showing continued pessimism and opportunities?
I think you're looking at that again. They've kind of. Here's the one thing you have to understand though about a lot of the prices of these gold stocks. One of the things that has driven the bull market in equities is financial engineering. Companies. If you go look at it, Microsoft, and I talk about this in the book as well, has 30% less shares now than it did 20 years ago. And that's kind of helped it. Because if you, say, let's just make it very easy. You have a company that makes $1 million and they have 1 million shares outstanding, it's $1 a share. If all of a sudden the next year they only have 900,000 shares outstanding and they still only make $1 million, so the profits having gone up, they make $1.11 a share, right? So you can artificially inflate your profits by that. And same thing goes with market cap. And most of these gold stocks, because they haven't been able, because they haven't generated cash flows, haven't been able to buy back stocks like the rest of the market has. A lot of these stocks, 2, 3, 4 times as many shares outstanding as they did during the 2011 top. So you may look at the GDXJ or a price of a company and say, well, this company, say company ABC, was $10 at 1,900 gold in 2011. Why is it only 4 today? But then if you go look at if the amount of shares outstanding is 4x as much, its market cap is actually higher now than it was in 2011. So I'm a little wary of just looking at the price of those things, because when you look at the market caps, the amount of shares outstanding, et cetera, in a lot of these companies, you'll see that a lot of these companies are larger companies than they were at the tops, and it's because of dilution. And that's why actually one thing I really look for gold stocks are the companies now that, again, are producing enough, are generating cash flow, and don't have to dilute. Because a lot of these companies that start diluting, this is where it ends up leading to. And we see this in the junior market all the time where, some company maybe hits a bunch of good holes, is able to raise money, all of a sudden has 500 million shares outstanding, when it used to have 50. And then all of a sudden, the stock goes down 90% because they have so many shares outstanding, their market cap, kind of comes back to reality. Actually, an example of this is I know a lot of people really like Northern Dynasty because they think the Trump administration might put the Pebble deposit, and it's just for the record, I have no interest in the stock and no longs, no shorts, no nothing. And back in, and I tell people, I bought Northern Dynasty. It was one of my first big winners in my newsletter back in 2002, at like roughly $1, and then we sold it at $9, and I think it went as high as 15 or so, and it's now $1.50, but it has literally like 20 times the amount of shares outstanding, or I think it's even more. I think it might be even 30 or 40 times the shares outstanding that it had in 2001 or 2 when I was buying it, and that means even at $1.50. The thing has like a $750 million market cap, or when I bought it at $1, it had like a $20 or $30 million market cap. So I think dilution is something you really have to look at. And the problem in junior mining is, you have to raise money to build up the asset and the property, and you don't have any revenues coming in. So it's not like, when Amazon, when Bezos was building up, remember he got criticized for years for not making any money, but he wasn't really diluting his own stock. He was just spending all the cash flow he was making on expanding the business, and he had cash flow coming in. So that's the real difference,
Your thoughts on the U.S. dollar?
It's an interesting trade because the problem with the currencies are they're kind of just basically all crap. You got basically a socialist government in Canada. You have Europe is, it got issues with debt and that as well. Australia is the same way. And so it's really difficult to like assess these currencies because all these economies have huge weaknesses. And actually in the U.S., even though we consider it maybe more of a mix or capitalist economy in some of these places in Europe and Canada or whatever, but the issue is their debt loads are some of the highest in the OECD and G7. Like outside of Japan and Greece, the U.S., if the U.S. wasn't the reserve currency, it'd be looked at probably as like a basket case, right, in terms of the debt load, right? So So that is kind of the negative, but then the other positive is the other things I mentioned. And one of the things that's helped these other currencies over the years, be it China, or be it Euro, the euro is at 150, is that a lot of these places run huge trade surpluses, and Trump's kind of trying to end that. So I'm bearish on the U.S. dollar because I do think the current administration, with their belief in trade and wanting to expand U.S. manufacturing, want a lower U.S. dollar. That's why they're asking the Fed to cut rates, because I think they know that will hurt the U.S. dollar. But I would just say that the really way to value the U.S. dollar is against gold or even Bitcoin or whatever, and I think you'll see that's where you're seeing the devaluation. Where, the U.S. dollar, the euro's rallied 10%. But guess what? Gold's gone and since late 2023, gold's gone from 1,800 to 3,300, right? So it's almost the double. It's got like 80, 90%. So that's like the U.S. dollar losing, like half its value against gold in that same time span, regardless of what it's done against the Canadian dollar or euro. And I think that's really the way people need to gauge it rather than looking at the U.S. dollar index. But I do think the dollar is kind of topping. I think you're going to have to see some kind of crisis or sharp decline in the stock market for the Fed to cut rates. Because again, if you look at the bond market, long-term rates, short-term rates, etc., nothing signaling that rate cuts are coming anytime soon.
Does copper look like it has good long-term demand?
Yeah, copper I'm positive on. It's used in a lot of the green energies, but it is an economically sensitive asset. But there isn't a huge amount of they call it Dr. Copper because they say copper goes with the economy, right? Because copper is also used in your homes for your electric wiring and and all kinds of other infrastructure type things. So. I am bullish on copper, and I know that the gold to copper ratio is showing that copper is very cheap compared to gold. But my issue is if we do get some kind of severe recession, that could hurt it. But another thing that helps copper is, with the demand, with more EVs being produced, and you need copper in those EVs, is that there isn't a huge amount of new production coming online. So copper might end up in the long run being more of a lack of supply story rather than anything economic or anything even monetary. But I am bullish on it, but I just think too, again, I always hate to go back to this bond market thing, but with the bonds in the U.S. acting so miserably right now, I don't think foreign money or funds or any things going into the U.S. bond market. I think that money is all going into gold. So, and gold is kind of the monetary metal, right? And then the smaller guys maybe use Bitcoin as a currency hedge. So copper is like okay, and like I said, maximum pessimism. Copper was something you should have bought in 2009. I actually made this comment at a conference I hosted in the Bahamas in 2009, and this is when copper was like $1.40 and gold was getting close to 1,000 again. And I said, because I thought we were at the bottom of the economy. I said I would actually like to melt down my gold and buy copper. So I'm not someone who's just a pure gold bug. Like at that time, I preferred copper. I remember one of the guys at my conference got really angry at me when I said that because he was a gold bug. But I'm like, well, it's the truth, man. And then if you go look at copper in the next few years, gold went up like 50 to 100% between that 2009 and 2011, but copper actually went up 3x in value. So actually, copper was the better trade at that point. But right now, I don't see the catalyst. Because what I really see on top of that supply problem as a catalyst for copper is we need the monetary tide to turn. And the Fed right now just has no interest in doing QE, in cutting interest rates. They're worried about stagflation from the tariffs. And, it's also probably, again, forget my language, it's kind of an FU to Trump because Powell doesn't like Trump. They don't get along. So, and can you blame Powell when Trump's always saying he's an idiot and should be fired and all these things, right? So I think that the Fed isn't going to do anything. And like I said, regardless of personal feelings aside, don't look at the bond market in the U.S. The 10-year bond's 450, 460. There's no reason the Fed should be doing anything right now. And I just think with copper, that's the catalyst. Usually when there's monetary stimulus, like there was from 2009 to 2011 when they cut rates to zero, like there was after 2020 when they did QE and cut rates to zero, I think you really need that stimulus to really drive it. So copper doesn't really interest me that much right now.
Your thoughts on crude oil?
Oil's the same way. I think, again, and I mentioned in the book that I think the oil could go into the 40s if we see a recession. And we have one thing that nobody talks about is, because everyone got wrapped up in drill, baby drill, is that the U.S. produces 13 million barrels a day of equivalent oil production. That's a combination of natural gas and oil. No country in the history of the world has ever done that. Even Saudi Arabia and Russia are around 10 million a day. So there's really not a lack of supply in the oil market. And again, if you see that slowing down in the economy, you're going to see less demand. And Saudi Arabia and Russia aren't cutting production. I think they're trying to put the frackers out of business. If you remember that the U.S. and Saudi Arabia kind of worked together in the 80s to, drive oil prices to under $10 at that point, because Russia's biggest revenue, even then when they were still communist, was oil revenues, and they used that to fund, the Soviets used that to fund their system. So anyhow, that's kind of what I think with copper, with oil, is I think that we're in an economic slowdown. There's going to be less demand. There's still too much supply. And it's, again, not really an appealing trade for me right now. The time to buy in oil was in 2020. Again, maximum pessimism. Remember when it went negative? That was the time to buy. So if oil could go back into the 30s and 40s, I obviously don't foresee negative oil prices again. That was a one-off because of COVID and the whole global economy shutting down for a month. But I do see, if you go look at 2008 or you go look at the early 2000s, I think you can go back into the 30s to 40s, and that's when you're going to want to really look at oil. And I think that's when there'll be a lot of supply destruction. I think that's when a lot of the frackers will go over. Because actually, one thing you have to understand about the frackers, one reason this big oil boom happened is the frackers are funded by debt. Again, me and you are Canadian. We're used to junior mining, which are funded by, private placements, equity, cash. The U.S. funds things by debt, a lot of these companies. So and you had this era of zero interest rates that were funding these companies, even though a lot of them weren't, profitable, even at $70, $80, $90 oil. Well, interest rates aren't zero anymore. That cheap money is not going to be not going to be there for them anymore. And I think you're going to see a lot of those frackers go under if you get a recession and oil goes into the 40s. And by the way, another aspect that's like an offshoot, and I don't want to pile on Trump too bad, but is of what he's doing is the tourism to the United States has completely collapsed. Like from Europe in the second quarter this year, and Canada, obviously, because the whole 51st state thing, you're seeing all tourism from most every European country, and from Canada down double digits, or in some cases 50, 60% year over year, and it's because, again, the kind of rhetoric and angering people overseas, and they're going to be like, well, I'm not going to do that trip to Miami, I'm not going to do that trip to Las Vegas, and where that comes in with oil is that basically, airplanes burn a ton of jet fuel. Right, and that really reduces the demand for oil and gas, etc.
Is there extreme pessimism in the oil drillers?
Yeah, I would say that. Okay, well, this is where it gets interesting. Is that I don't really want to buy Chevron and Exxon. I talk about in the book because and this would be like Suncor's like this. Although I do like Suncor, but those major producers, they sell gas at the pump, right? And a lot of their revenues, and this has been shown by the studies, actually come from, when you go into a gas station, maybe you buy a Twinkie, right? Or maybe you buy, if you're more healthy, you buy a little thing of vegetables, right? Like the celery sticks or carrot sticks or something, right? But that revenue actually makes them about as much money as oil revenue. So that's why I don't like them, because they tend to be just these macro plays. You look at Exxon, it tracks the Dow or S&P more than it tracks the oil price. But definitely Schlumberger, Halliburton, and also those companies could benefit from, say, an implosion in the frackers, which I mentioned, because they're mostly offshore drillers. They're in the Gulf of Mexico or America or whatever you want to call it, and they're offshore. And basically, those companies, I think, and they're more beaten up and cheap than the kind of mainstream oil plays. And what I really like, again, even though I just talked about it right now, I don't think they're quite cheap enough. I really like those Canadian companies, like Athabasca, Suncor, because if this government in Canada ends up being short-lived and the Conservatives come in and win again, and they can build some kind of pipelines, that unleashes that production from, the oil sands. And let's face it, even something like Alberta separating happening, that does the same thing. And that really bodes well for those companies. And again, if you go look at their balance sheets, they're much more solid companies than the frackers. But again, with maximum pessimism, you need that catalyst. And one unfortunate thing with Carney winning the election, that kind of energy, that catalyst to unleashing like energy production isn't there right now because he's so much into the green movement.
For investment, is India looking better than China going forward?
Yeah, that's a no-brainer. Now, China has better valuations, but India has everything you want in emerging markets. It's got a young population. It's got a growing economy. India has, top-tier companies, Tata Motors, Infosys, etc. The valuations in India aren't the greatest right now. But also India has real accounting. Like those companies that trade on the NYSE have real accounting. Chinese companies, who knows what they're doing. And China's kind of looking to me like Japan in the 1990s. Everyone thought this was going to be the next superpower, but then Japan ended up having too many real estate bubbles, too many asset bubbles that the government kept, bailing out, had poor demographics. And I'm telling you, China has all those things. So China is coming on in terms of, the largest EV maker in the world is now China. At some point, China is going to start making their own aerospace, airplanes, etc. So they do have that aspect of it. But I just think the big issue is, look at Japan, Mazda, Toyota, Honda, etc. All these huge, Nissan, all these huge auto companies, Sony on the electronic side, Nintendo and gaming. So there's huge companies from Japan, but Japan has been stagnant a lot due to debt and demographics, the two Ds, and China has the same issues and problems, right? So, and I also think and I don't like to trade based on politics, but from like a philosophical point of view, with India being, a former British Commonwealth country, with it being a democracy, with it, even if it's a clunky democracy, you kind of want India to succeed as a Western person, because if the U.S. does to begin to fall off as a global superpower, I would rather have that void filled by India than China, because China, notoriously has no, respect for human rights. It's obviously essentially just a fascist communist dictatorship. So I would like to see India succeed as well. Of course, again, it's very difficult to govern a country of 1.4 billion people, especially, like I said, in this kind of clunky democracy. But, I definitely would. I think India is like a no-brainer. Like the IFN, which is the Indian ETF I talk about in the book, it pays a huge dividend. It actually, including dividends, again, has outperformed the S&P over the past 25 years. That's the kind of thing that every time it has a 10, 20, 30% dip, I would just buy it and forget about it. If you have kids, buy that for your kids' retirement, and just forget about it for 30 years. Because I think India, and also India from social point of view, I don't know if you've ever read, obviously there was the movie Slumdog Millionaire, but the book is actually, even though the movie is good, is the book is even better. And then there's another book called The White Tiger. And it just reminded me when I read these books, I go, this really reminds me of like the UK in the 1900s, and reading the Charles Dickens books, and where the debtor prisons and this and that, where it's like this, there is these huge differences in wealth inequality, but it's this booming economy, and there's these interesting sociological like differences going on, in the different demographics and whatever. So, I think India has a real culture too, right? Like Bollywood. You think the people in Hollywood are famous? Go to Bollywood and go see like when these guys do an event outside in New Delhi or Mumbai. Like they're way more famous than even like Tom Cruise is in the U.S., right? So I think it has its own unique culture as well. So yeah, I definitely like India longer term, and even the countries around it, Pakistan and Bangladesh and Sri Lanka. Even like Indonesia, a lot of those countries in Europe in Asia are very cheap. Vietnam being another one. I like all of them going forward, but India is kind of like the giant. Just like if you had invested in Canada 100 years ago, if there was an ETF 100 years ago, you would have done great. But the superpower to invest in 100 years ago would have been the U.S., right? So that's kind of what those other countries are to India.
Is lithium seeing pessimism?
Yeah, it's cheap, and obviously there is going to continue to be growth in EVs, but here's the issue with lithium is most of the supply comes from China. A lot of those lithium is very toxic, very difficult to get permitting for, right? And I know you're out in that city, but I have an indicator I talk about in the book called the Vancouver indicator. And with all due respect to the promoters out there, they're pretty sleazy. And whenever they get bullish on a sector, and this happened, basically, let's face it, the basis of the former VSE, now CDNX, is gold and silver mining. But whenever a sector gets hot, like tech in the late 90s, uranium in 2006, crypto in 2017, 2018, those Vancouver promoters love to jump on it. And guess what they all did in 2020 and 2021? They all turned their precious metal mining companies, or not all of them, but a lot of them turned their precious metal mining companies into lithium.
Where is uranium on pessimism versus overvaluation?
I think uranium stocks have pretty good valuations. Like I said, they already went through that bubble and bust phase. So, and they actually, again, this shows you, here's the thing about doing this pessimism trading. This is not a month-to-month trading. This is not quarter-to-quarter trading. Sometimes you have to wait years. And my feeling always is, like I said, if you can get 3, 5, 10x in 5 years or something, I think that's pretty good. So the time to buy, for example, Cameco would have been when it was like $8, $9, I think, back in, I guess it was there in like the late teens, like 20 teens and early 2020s. And then it's had this great move. But there is a lot of the fundamentals are good for uranium. It's probably the most green friendly of all these green energies, solar, wind, etc. So I'm still positive on uranium, but it's not super cheap. And a lot of these kind of alternative energies, again, solar, wind, uranium, etc., they tend to trade somewhat with the oil price. So if oil and natural gas get very cheap in a recession, that will probably hurt it a bit. But yeah, I look at the valuations of the companies, and I think it's definitely worth having a small percentage of your portfolio in it. It's nothing that overly excites me. One issue I had early last year was I remember doing these podcasts, and they were commodity podcasts, and I was like, wow, everyone's bullish on uranium. I want nothing to do with it. And then most of these stocks fell 50% in a year. So, but they did actually, the day we're doing this podcast on the 23rd of May, they actually, a lot of uranium stocks are up like 10, 15, 20% today. So it does look like they're kind of coming out of this base and could do well. But again, to me, and also too, look, commodities, terrible business. The overhead, it's very cyclical. Like uranium's something that should be like a few percent of your portfolio. It's not something like to dive into.
Your thoughts on these sectors, AI, 3D printing, and 5G, 6G?
Well, what's interesting is one of them is in a bubble. So AI is going to be the next internet, technology. But I do think, like the internet, we need to see some sort of basing happen, some kind of bust and basing. Like NVIDIA, these stocks have all, I talk about parabolic curves in the book, and that, that's when something goes up almost in a 90-degree angle. And, some people call it also like a skyscraper chart where it then just kind of comes back down. And that's it. All parabolic curves collapse. That's kind of a rule, but you don't know how high the parabolic curve can go. That's another part of that kind of trading in it. So AI, even though longer term is great, I'm staying away from because I think we need the bust. Most of the AI companies tend to be like semiconductor plays in it right now. But I think there's going to be all these things, and people don't even look at alternative AI investments like in media. Like AI is going to get so good, you're going to be able to make movies that look super real. You just get the licensing to use the images of, say, famous. You can go to Tom Cruise when he's 70 years old and say, hey, we're going to do another, Top Gun. But you're going to be the AI. It's going to just be using your voice, and you're going to be the AI guy, and you're going to look like you did when you're 25. And that actually will probably cost them a lot less money, and that sort of thing. And then even in the adult industry, like AI is kind of booming right now. There's all these AI adult sites, and I think that's actually going to longer term kick the ass of if I can use that term, of OnlyFans and all these other adult current way in these all industries. So I just think that AI is going to be gigantic, but a lot of the new companies aren't even around yet. Like I always use this analogy that people don't realize Google didn't trade till like 2003 or 2004. It wasn't even around during the dot-com bubble. Even like Amazon, Yahoo was one of the big companies back then. Like it's in the first phase of the bubble, these companies aren't going to really be around at some point. Like, look at cell phones. And actually, to segue into 5G, Nokia, Ericsson, those were the big players in the late 90s when the cell phone started, and they're now big players in the cell phone industry. BlackBerry doesn't even make cell phones anymore. So, and actually, BlackBerry is a great AI play, in my opinion. I talk about in the book how they're doing a lot of things with autonomous cars, and it's become a very cheap company, and it's maybe a cheap way to play AI. But anyhow, with 5G, Ericsson and Nokia, I think, are two of the leaders. And with all the issues we're having with China right now, and look, this is where I will agree with Trump. I don't think we should be doing much with China and those kind of industries, because China can, use those industries to spy and, kind of infiltrate our technologies and our economy. So Ericsson and Nokia make 5G networks, and I think that's going to be a great way to kind of maybe, again, they're cheap stocks too, good ways to play it. And with 3D printing, this is, again, classic example of a bubble. You go look at all the 3D printing stocks in 2014. They were kind of the first tech bubble of this bull market that started in 2009, and they all collapsed 90, 95. Some of them were down at 98 or 99%, and a lot of them have not come back since. But now you're seeing the reemergence of the technology. You can 3D print homes. You can 3D print car parts. You can actually, the FDA recently approved 3D printing of dentures. So, and let's face it, with the baby boomers probably not going to have as much money as they think. And, as you get older, everything breaks down. If you need dental work, you might just want to buy some cheap 3D printed dentures instead of having to spend tens of thousands of dollars at a dentist, right? So there are all these great opportunities in the 3D printers. That's definitely a sector, and I talk about a few companies. I would buy a basket of them, and I think at some point, they'll move. Like, for example, a lot of these companies in 2014 at the bubble top were trading at 20, 30 times revenues, and now they're trading at 1 times revenues.
Where can people get your new book, Mega Returns Profit from Maximum Pessimism?
So, like I said, Amazon and through Newsmax.com, and the promotion there are the two best ways to get it. And also on my own website, which is profitfrompessimism.com, we have a special deal right now where I have a basic tier at $5 a month, which, by the way, in a few months, this is a special book deal. I'm going to raise back to about $7 or $8 a month. That's U.S. prices, by the way. And then I have a lifetime subscription, which is much more advanced, has much more trading things. Like, I give out my phone number to lifetime members, and they can ask me questions. And that's $900 usually. And I actually have a sale. If you show me proof of purchase of the book, I'll give you a $200 discount, and you'll get the lifetime subscription for $700. Again, that is U.S. dollars, so that's roughly, you're in Canada, that's roughly $1,000 Canadian. So, that's it. So, basically, but to get the book, Amazon and Newsmax are the two best places.
David, thank you so much for being on This Week in Money.
Thank you for having me.
My guest has been David Skarica, author of the book Mega Returns Profit from Maximum Pessimism. His website, profitfrompessimism.com. He was speaking to us from the Bahamas. Coming up, Josef Schachter, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter.Energy Report online at Schachter.EnergyReport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money.
Good to be with you again, Jim. Pleasure.
Josef, you have a special offer for our listeners.
Yeah, we're a lot of people like our Ion Energy, and they've said to us, well, number one, can you get more access throughout the continent, so U.S. as well as Canada? It was mainly distributed in Canada on our website or through X, Twitter, and LinkedIn. So we're making it available now on Substack, and so people can go to Ion Energy or Josef Schachter's Substack, and they can get access to the weekly report Wednesdays usually, except when you have Monday where the U.S. is on holiday, and like next week Monday, and the EIA oil data is not available. We're also going to change it a little bit and add a little more U.S. information. Right now, we of course cover the EIA data and the Baker Hughes data, but we're also going to cover some of the ETFs to give people an idea of what we're thinking there, because we normally in Canada just talk about the S&P TSX Energy Index and then what we think is going to happen with oil. So we're going to continue to do that, but we're going to have a section there on the biggest American ETFs so people can get a feel for what our thoughts are applicable to the state. So just go to Substack, the website, where you can, the app, and then go to Ion Energy or Josef Schachter, Ion Energy, and take advantage of it. We're leaving it on for 3 months for free, and then starting in mid-August, we'll be charging for it. So it's a good way to build interest, and then during the 3 months. And then it'll go on annually for $250, and then for monthly, it'll go for $30 an issue, or for the month. There'll be 4 issues every month normally. So for people who would like the ease of and are used to using Substack, that's become a big source for Doomsburg and a lot of oil and gas services, a lot of stock market services. So we've just migrated based on just the social media benefit of being where a lot of other services are and where a lot of people are comfortable going in and signing up for product.
An interesting coincidence, crude oil topped in early 2022 around the same time the housing market did. Since then, crude has dropped in half. Do you think there's any correlation between crude and the housing market?
Well, I don't think there's a high correlation, but I think economically there you could argue, when we have weaker economic conditions because of, job losses, because of the whole issue of the tariffs and people being nervous about spending money. A lot of people are living paycheck to paycheck. So if they use less gasoline, that means crude oil comes down. And crude oil today is at $60.84, down 73 cents. It was a couple bucks higher earlier in the week. I think it's going down to test the mid-50s where we were in early April. So we're saying to people, we're going to have some weakness here in the general market. We're going to have some weakness in the price of oil, but we'll probably see another buy signal like we did in early April sometime during June, and we recommend people take advantage of that. So figure out what names you want to own, and the potential is that it could be 10-20% cheaper sometime during late June, and we'll send out a buy signal, that we think the correction is over, and we'll put that both in our Ion Energy on Substack and in our normal SCR product, which is where we have the company information. Ion Energy is the macro piece, and the SCR is the company specific, plus some macro with charts and stuff. And my views on markets into a more greater degree. And that's our SCR product that people can go to the website. We cover 37 companies there: pipeline infrastructure, royalty trusts, E&P domestic, E&P international, energy service. So it's a very encompassing product, and it's grown very nicely. As we've taken advantage of these major bottoms. April of this year was one, March of 2020 was one, 2009 was one. So we've been in the business for a long time. So whenever we see these massive, cycle bottoms, we're recommending people take advantage of them. And as you know, we got down to about 54, 55 at the low. I think we're going to probably test, between that and 56 sometime over the coming weeks. And that'll give you another great buying opportunity. Today we saw, oily stocks hold in, but the natural gas stocks were down 2 or 3%. And so if you can buy them 10% cheaper, a lot of these companies have fabulous dividend yields. So there's a lot of bargains out there today, but there'll be even better bargains a few weeks down the road.
Crude's been trading around $60 since April. Do you have a bullish case and a bearish case for crude oil?
Yeah, the bearish case is the one being carried right now, and that is that OPEC's going to increase production, by another 411,000. So in May, 411,000, in June, 411,000, and then in July they're going to make a decision and bring on another 411. The reality is they're giving quota they're not bringing on real volumes. They're giving quota to people to countries that are cheating. And so all it is normalizing the cheating as being as now being acceptable quotas. The only countries that really could bring on real barrels are, of course, Saudi Arabia and Kuwait. And the reality is, I think that, Saudi Arabia is looking that by summer we're going to see the tariff issue resolved. China will start showing some growth again. And U.S. and others will be stable, and the demand will be there. The way I'm looking at it is, the bears are saying global demand in 2025 will be 800,000. The bulls are saying 1.4 million barrels. So if it's 1.4 million, then whatever OPEC brings on will be needed. But they're missing a point of why I'm very bullish into the fourth quarter of this year, and that is Venezuela. As of May 27th, the Trump administration has said to Chevron, Repsol, and Eni, you're no longer buying that crude. The buyers of it were China, Teapot Domes. They're not buying it anymore. They've said after May 27th, no more. You've had the Indian refinery Reliance, which is the biggest refiner in the world. They're saying no, they won't be buying it. So from just under 1 million barrels to 500,000 is likely between May 27th and the last quarter. So that takes up one of those months of OPEC production. But the real one is going to be Iran. Iran right now is producing 3.4 million barrels per day. They of course are facing the U.S. sanctions if they don't sign off on a nuclear deal, and I think that's more and more likely that is what's going to happen, where they don't, that they've said that they want a nuclear program. The Americans are saying no nuclear program, and so if that is the case, then they're going to lose potentially 1.5, 1.6 million of that 3.4 in production, and that's going to give you a real big upside in terms of the price of oil in Q4. And I think we'll be in the $70 range comfortably, and potentially peaking above 80 on very cold weather during November, December.
The U.S. dollar's been trending sideways. Would a rising or declining U.S. dollar be better for oil?
Well, historically, when the price of the dollar goes up, the stronger dollar brings higher oil prices. Declining dollar means lower prices, which we did see with the recent weakness in the dollar. But we're now seeing the U.S. interest rates going up, and the 10-year and the 30-year rates have gone up because of the concern about the amount of the debt. There was a 20-year auction this week that didn't go well. The bid-to-cover ratio wasn't good. The yields went up. And, of course, we're looking at, $2 trillion deficits right now. If this budget proposal gets through the Senate, they're talking about potentially $4 trillion more to the debt over the next 4 years, which means, $400 billion more to the deficit. So while they talk about cutting spending, the offset of the tax cuts more than offsets that, and the U.S. just keeps on, spendthrift ways. Well, and Canadian government's the same way. Governments all around the world don't seem to care about the balancing budgets. They keep on saying, let's kick the can down to other politicians and future generations, and we're just going to go on the spending spree and enjoy it, and, of course, pay ourselves more. You see, parliament after parliament and, other places around the world increasing the salaries of members of parliament, cabinet ministers, all that stuff. So it's a gravy train that they're enjoying, and the poor taxpayers are getting, stuck with bigger and bigger deficits, and they hide it. We're not even going to get a budget out of the government of Canada until the fall, and the deficit's just getting bigger and bigger. And, you look at Chrystia Freeland resigning, it's because, part of it was she saw the deficit was way bigger than she thought. And, of course, all the government giveaways that they're talking, tax cuts and other stuff, she didn't agree with. But she's in the cabinet again. And, so it's, politicians just like to be in the political eye. Where's the backbone of facing these issues? And you sure don't have it in Canada. You sure don't have it in the States, in the elected officials that are in power. We did have the Conservatives talking about balancing budgets and living within means, but they lost, in the end. And it was effectively right versus left in the battle, and the NDP and the Bloc lost ground. So to me, we're looking at an issue here that is not going to change. And from my point of view, I think interest rates are going higher. Even though, part of it's going to be tariffs, part of it's going to be the lack of buyers of bonds. In other words, right now for the U.S., the biggest owners of their bonds, U.S. Treasury bonds, are Japan and then China. China, of course, doesn't love America right now, so they've been selling and lowering their bond exposure. Trillions of dollars is what they have. And then we've got, the Japanese, which are in the midst of a trade battle with the U.S., and one of the, hammers they have is, we could sell our bonds. And with their interest rates going up, owning U.S. bonds is not so attractive for the financial intermediaries, insurance companies, pension funds in Japan, that you might have the private sector in Japan selling U.S. treasuries, and then at some point maybe even the government. And rising interest rates, we're near multi-year highs on the 30-year, and we're, the 10-year, is just a couple ticks away from multi-year highs. If we punch through, 5% on the 10 and on the 30, I think that's going to be a 2x4 to the general stock market, just because of the discount mechanism where interest rates tells you what PE you'll pay. Rising interest rates say lower PEs, lower interest rates say higher PEs. Well, higher PEs is going to go to lower PEs.
The Canadian dollar continues to show strength. Is this good or bad for exporters and importers of energy?
The Canadian dollar being strong for exports is not good. You really want I don't think we want 65-cent Canadian dollar, but the U.S. dollar, the move we've seen recently, we're 1.38 or 1.37 conversion, so that helps. Our raw material producers, that sell internationally, be it potash, wheat, lumber, oil, natural gas, times 1.37 is a pretty good price. I don't think the Canadian dollar, based on our deficits, based on the, the battle that's going to happen between East and West, in terms of, the economic growth that Carney's talking about. He says he wants us to be an energy superpower, but does he talk about that being natural gas and oil, or is he talking hydrogen and other stuff? Quebec, pipelines through Quebec are a non-starter, I don't think, unless something really changes there materially. And then I think the potential for pipelines on the West Coast, Premier Eby seems more interested in it now. So potentially, not only will we have LNG Canada starting up with the first cargo going away next month, but we're going to probably see, 4 or 5 more projects between now and the end of the decade. So right now in Western Canada, we may produce and sell 18 BCF a day. That could add 6 BCF of demand by the end of the decade. And the industry is not spending a lot of money to even increase production. They're just, replacing decline rates. So it could be a very big stimulus to the industry, and prices would improve to make it economically incentivized for companies to drill and bring on not only liquids-rich natural gas but dry gas, and that would be the dry gas, and it would be going to the coast into these LNG plants, and then off to Asia, where you can get maybe $15 US on MCF versus $2 Canadian right now in Canada.
What's the latest on rig data?
Well, the U.S. side is still pretty sluggish. It really is a problem, down about 4.6% from a year ago. The gas rig count is 100 versus 103, but the oil rig count is 473, down from 497, down 4.8%. And the reality is these lower prices now are making tier 2 and tier 3 inventory not attractive to drill. So only tier 1, which has economics where you get a payback in 1 year, and you get good reserves and you get good high production. Those are the wells that are being drilled, but the number of wells being drilled is down. The number of frac crews that are working are less. So that's on the oil side for the U.S. In Canada, because of spring breakup, we've seen natural gas rig counts stay sloppy, down only 47 rigs working versus 57, but the oil rig count 74 versus 57, up 29.8%, and that's because the oil that's coming on is going on the TMX pipeline to the BC coast and being shipped. And interestingly, China is now a bigger buyer of our crude oil than the United States. It used to go down to California, Washington State, and then some of it that went to California was transshipped offshore into bigger ships that would then go to China as well. So China really is buying the biggest portion of the Canadian production. You heard from our from the prior environment minister that it's only at 40% capacity. He doesn't even know his own numbers, and it's 77% and heading into the 80s utilization. And he was saying, well, we don't need any more pipelines because we don't have this one full. The reality is, it doesn't. If he's a minister and that's what he thinks he knows, we're in big trouble because he sure is an empty head, not knowing his facts, which is scary. You want your ministers on the ball, knowing their portfolios, and he's not even in the portfolio anymore. But he sure doesn't know his facts. So I think that we probably have 1 or 2 more years of growth on the TMX line, and then it'll be full, and then we're going to have issues again. We used to send a lot of crude oil by rail. You may have seen the Strathcona announcement last week where, number one, they are selling their natural gas assets to ARC and to Tourmaline, but they're buying and then they made an offer, they made an offer to purchase Hardesty's rail terminal so that they would have a rail terminal that can move oil by rail tanks to the United States, Western Canada, Eastern Canada, and there's no stopping rail. It's not a pipeline issue. It's more expensive, but owning that Hardesty is going to help them. And then you saw them say, we want to be bigger in oil sands, heavy oil, SAGD, and Strathcona made the bid for MEG, or verbal bid. They haven't done the formal bid. Sometime in the next week or two, that should happen, and then MEG will be in play, and we'll see, does somebody else come in? Some of the owners of MEG are saying that, Cenovus will come in, Imperial will come in, CNQ will come in. I'm not so sure that we're going to see many bids, if we do see any competing bids. Once the official bid's on the table, we'll find out if there's going to be an eager entity to want to buy it.
Canada's new Prime Minister, Mark Carney, do you think he'll favor green energy over oil and gas?
His whole life, his whole career, everything he's done in terms of, his career-wise, his writing, he's part of that, forum in Switzerland, like Trudeau was. He's green energy, green. But I think he realizes that, the revenue that comes into the Canadian government, the revenue that comes into the provinces, a lot of it comes from royalties and taxation and wages, for people in the oil patch. And I think there was a study saying that 9.8% of Canada's GDP relates to the oil and gas industry. So you don't want to kill the golden goose. It lets government have the ability for all the largesse that they do and all the social programs. And of course, this new tax cut that he wants to put through. I think on that he's trying to copy, President Trump. But the reality is they've already got obscene deficits. This just makes it even more obscene. And he's not doing the things of removing regulation like they're doing in the States. They're not saying drill, baby, drill, and get the energy industry open, allowing federal lands to be open offshore in the Gulf of Mexico, opening it up. The Canadian government is doing none of that. Their view is going to be green energy, so there's going to be more solar, there's going to be more wind power, they of course want to be big in hydrogen, but again, the product that pays the bills today is oil and then natural gas, and you don't want to kill the goose that's giving you the largesse and the wealth that's made Canada. Everybody talks about Russia and the wealth of Russia with all the resources they have, and that might be one of the reasons why the EU, would like to see Russia broken up, because they could then maybe buy parts of it from, whatever happens there. Russia is the second largest producer of oil. U.S. is about 13.4 million barrels a day. You've got just over 9 million a day Russia, just under 9 million a day Saudi Arabia. And then you take Canada, around 6 million barrels a day. So we're the fourth biggest powerhouse in the world on energy production. So you don't want to, and that's oil side, and then add that to the natural gas. And, it's a big part of the wealth creation for Canada. And, do you really want to stop hydro going from Quebec into the northern U.S. states? Are you wanting to cut, forestry, aluminum, from Quebec going into the States? Are you going to stop the car industry from Ontario going into the States? And here you got Carney saying, oops, we're going to stop fossil fuels going anywhere. That totally ridiculous and totally incompatible with his comments about growth and the desire to see Canada become an energy powerhouse.
President Trump is working on stopping wars and bringing countries to the table to make trade deals with the U.S. Would wars or trade deals be more bullish for crude oil?
Well, wars would be, if there was something where, there's a war with Iran and they closed the Straits of Hormuz, you'd probably see $10, $20 up quickly, just like when you saw Iraq invade Kuwait. That popped the price of oil, 50% very quickly. When we saw Russia invade Ukraine, we saw the price of oil go up, 40, 50% very quickly. And then, so it is a destabilizing war. Trade deals, once everything settles down and we have rational trade, then the economies of the world will pick up. And of course, if we want to go to a transition where we are getting more, solar panels and wind turbines, and we want to have more electric vehicles, and that's going to mean we need more lithium, we need more copper, we need more nickel. That's going to happen in Indonesia and parts of Asia, South America, Africa. They're going to need to build the mines more energy use, and the people working in the mines are going to want higher quality of life, which means they're going to be bigger users of energy, being it oil and natural gas. So to me, the big thing about getting this world settled down, and if we want to see a more efficient use of energy and a better climate around the world, and not as many emissions, and the problem you've got is that for all of what we're trying to do in Canada, China's adding a new coal-fired power plant every week. So it's nuts that whatever we're trying to do here is so marginal, versus if we could send LNG to China and India and they would stop using coal, or dirty coal especially, the world and the planet would be better off. But our politicians seem to think about our official borders, not the global benefit. And to me, that's absolute stupidity.
President Trump was in Saudi Arabia strengthening the relationship with the United States. Could this be a recipe for lower oil prices?
Currently it is because, he got them to announce another 411,000. He wants low oil prices so that people can see the benefit that while the trade side might mean that Target and Walmart are going to raise some prices, they can see one that they do every week when they go to fill their gas tank, that the price is down, and they'll give President Trump and his administration a little more time to resolve these trade deals. Look, the trade deals are important. When you got out of the Second World War, America was the buyer of everything so that they could help wake the world up and help Germany and Europe recover, help Japan recover, and so it was important for them to be the buyer of all the products being made. But that, was maybe good for 20 years. But since the 1970s and 80s, America's been taken advantage of, and millions of jobs have left. In the Carolinas, they used to have a massive furniture business that's gone. You've seen auto jobs gone. You've seen, manufacturing of semiconductors gone to Taiwan. I'd be worried about, Taiwan because, China kind of almost lathers itself wanting to take that country over, that island over. So to me, I think that the geopolitics will affect oil prices, and if the tariffs are resolved, I think we're going to be looking at more demand for energy, more demand for LNG, more demand for oil, and that will make 2026 prices. I think we'll see 80 to 90 in 2026 for WTI, and I think you'll be looking at $5 and $6 for natural gas. AECO, as I said, was sub $2 today. Canadian NYMEX U.S. price $3.30 U.S. I think we'll be looking at a couple bucks higher on both sides of the border.
Are geopolitics having an effect on the price of crude?
Yeah, for sure. Right now, if you remember, we had a pop earlier in the week a decline earlier this week because everybody was talking about Iran may come to a nuclear deal with the U.S. That doesn't seem to be the case. And then you had the comment and the price went down further, as I mentioned, to 60.77 for the U.S. WTI because of Saudi saying they're going to add not only 411,000 for OPEC in May and the same in June, but now also in July, and that brought the price of oil down. And I think that soft demand now, like we're seeing right now, the U.S. This week showed inventory build of 1.3 million for commercial stocks, 5.8 million for total stocks. So we're at the seasonal period where demand is weaker and stocks build. But summer driving season is first week of July on. That's when demand should pick up. Canadians will probably be driving around more in Canada, and of course, Americans, aren't going to be wanting to go overseas that much. So I think that they're going to drive more in the States. So I think domestic consumption in both Canada and the States will be higher starting in July. The U.S. exported last week 3.5 million barrels to the rest of the world. A year ago, they were shipping 4.7. So that kind of highlights to you that the demand around the world is softer, and people like China are not buying from the U.S. because of the trade war. So I think you've got issues here that have to be resolved, and China and the U.S. lowering the from 145 down to 30 and from 115 down to 10 was a good thing, and I think it's clear that President Trump blinked, but now they're talking. Boeing can now sell planes. All the planes that were already built for China are being shipped to China, and Boeing is allowed to sell more planes. Both there, they did big orders in the Middle East. I hope Boeing's got the factories working properly because you don't want any problems there. But the bottom line is, I think once we get into the summer driving season, that should firm up prices, and then once we see sanctions hitting Iran and Venezuela, which will hit in the fourth quarter because it takes time, If you recall, in the first Trump administration, when they put the sanctions on Iran, they went from 4 million barrels a day to 2 million barrels a day very quickly. And during the whole time of the Trump administration, they had that 2 million off the market. So we could lose 1.5 million, maybe more. If America doesn't see a deal in the next few weeks, then they could announce something in June. It takes time for that to impact, shipments. But by the fourth quarter, that would mean we would have 1.5 million barrels off the market from them, 500,000 off the market from Venezuela. And if the demand growth is 1 million barrels for the year, there's a swing of 3 million barrels. That's going to mean higher prices.
I think you've pretty well answered this, but are there summer seasonalities for crude and natural gas?
Natural gas, of course, is, for air conditioning, power for air conditioning. And we all, in 30 degrees Celsius temperatures, we all turn on the air conditioner so we can sleep at night. So, yes, it does impact it. And you can have, when you have very warm weather, also when you have the hurricane season and the production in the U.S. Gulf Coast and offshore gets shut down, that can punch the price up. On the oil side, it's gasoline demand, and gasoline demand last week in the States was 8.64 million barrels. A year ago, that was 9.32. So that just shows you that these, Americans have come back and driven less because of the concern about the economy, job security, cost of living. We all know, insurance costs are higher, auto prices are higher, food prices are higher. So the family budget is constrained. And so if you don't have to drive, you're not driving.
What's happening with large cap, mid cap, and junior energy stocks?
Well, they've all seemed to pull back. So we've seen C&Q pull back. We've seen Tourmaline pull back from its highs. And you've seen intermediates and juniors also pull back more so than the big caps. And with the price of oil at 60, people are nervous that the industry is not going to have a lot of free cash flow. And there's some real bears out there saying we're going to 50. I think we're just going to go down and touch mid-50s for a short while. And that's why you'll see stocks come off and you'll get some great buying opportunity. But normally these spikes down are very short-lived, and it's like a V bottom, and it just takes off, as we saw in Q1 of 2009, as we saw in 2020, as we saw in April of this year. And as we saw other times just people should just pull out a WTI long-term chart and they can see this V-shape situation. So I think that between now and year end, a lot of the intermediates and juniors have been so beaten up that if I'm right that we have $70, $80 handle during November, December of 2025, I think there's 50% or more upside in many of these stocks that are right now unloved and nobody's looking at them. And I think people should be, finding the names that they like. You can find companies with very low debt, very strong balance sheets, very decent dividend yields. And so you can get more than you can get in the bank from many of these companies. Many of them have active NCIBs, normal course issuer bids, buying back the stock because they know how cheap it is relative to their NEVs. So I think that, for me, I'm bullish, but I'm going to be a table pounding bullish sometime in June when we get down into the mid-50s for that short period of time. And when we have the stock market having, today, if you remember, today being Thursday, we had a big push upwards in the market early in the day, and it ended up flat. I think the general stock market potentially has thousands of points down on the Dow and the Nasdaq, and maybe 1,000 points down on the S&P. So if that happens, and you saw how quickly that can happen in late March through early April, if something like that happened, that would provide a table pounding buying opportunity for most parts of the stock market. But my area, the energy sector, would be bargains, and we would tell that to people via our paid product in terms of specific names And in terms of the Ion Energy, they'll be able to see that on Substack.
Do you think we're heading into a commodities super cycle?
I think we've started one, and there's corrections along the way. In my career, the first one was 74 at 81. We were under $3 oil. Japan became the new entrant buying because we were all buying Panasonics and Sonys and Datsuns and Toyotas and everything. So they became a bigger buyer of energy and the price was so low, nobody was really spending money bringing it on. And at the end, of course, we had the Shah of Iran deposed, which put the final spike up to $36 WTI. So from under 3 to 36 was a 12-bagger, and many stocks went up 15 times between 74 and 81. Then we went into a decade or more of deadwood, too much production, weak demand. Price of oil went down to $10-11. And in 1999, the next cycle started when Deng Xiaoping said, we will allow capitalism under a communist system umbrella. And China went from 4 million barrels of production, consuming 3.5, selling 500,000. All of a sudden, as capitalism took hold, they grew to 14 million barrels. 10 million of that was imported, and that took the price of oil into the summer of 2008 from 1999 to 147. It didn't mean we didn't have 30 and 40% corrections along the way. Markets get too euphoric, and then they get overbought, and then they correct. And we saw that with everything from CNQ to Suncor to middle cap names. And then our job is to tell people when we're overbought, and we tell people when we're oversold. I think we got overbought, last year. And I think, in the first quarter when we were in the mid-80s, I think we're going to be oversold. We were oversold in April. I think we'll be oversold again in June. And I think people should take advantage of it. I think before the end of the cycle, at the end of this decade, maybe early 1 or 2 years into the next decade, I think the price of oil nominally will be above the 147 we saw in 2008. And I think we're going to probably see $5-6 for natural gas, and that will make for a very lucrative industry. And of course, companies, as the price of oil goes up, it's a question of build versus buy. And so build means drilling, getting the land, doing the seismic, doing all the technical work, getting facilities, or is it cheaper to buy on Bay Street or Wall Street? And if you recall in past cycles near the top, we saw a lot of M&A activity, takeovers. We're seeing takeovers now, but this is nothing compared to what we'll see, 3-4 years down the road.
For your subscribers, do you look for capitulations in the energy markets and stocks?
Yeah, when people talk about April and say, we had capitulation, oil was cheap and that, but we didn't see, retail capitulation like we saw in Q1 of 2009 or in 2020. With COVID, retail was in there buying, hedge funds were leveraged. So we never saw panic by leveraged investors. I think this time with rising interest rates affecting bond values of portfolios, and then if you have margin on that and margin on stocks, and all of a sudden the stocks turn down, and you get margin calls, you sell what you have to sell, not what you want to sell, and that's when panic can develop. I think that's possible over in this June period, where if we come down, we've seen down moves of 1,000, 2,000 points, up and down. If we start seeing, multiple days of down 1,000, 2,000 points, I think that will cause some fear, and margin account investors will be liquidating, and they have to sell what they need to sell to meet the margin calls, which mean the big cap, large liquid names will be where the bargains are coming. And for bargain investors, pick a name you like, and be ready to put in a bid, and I remember in 2008 that, IBM, Procter & Gamble, stocks would drop 20, 30 points in minutes. And if you stuck a, cheap bid in way under the market, you got filled. So, if you want to own, a Tourmaline, if you want to own, any of the names, ARC or, CNQ, put in a bid near the lows of April. And if the market goes down, as I think it will go down, you might get your bid filled, and you'll get yourself a really good bargain price.
We're hearing that 1 in 4 new vehicles sold is electric. Are sales of gasoline and diesel declining worldwide?
I'm not sure I believe that number. If maybe that's a number for China and maybe some of the European countries that are kind of banned fossil fuel vehicles or hybrids even. I don't think that's the case in the United States. I think, the U.S. is a 16 million a year car market. And I think we're 1 million cars sold in the States that are electric vehicles. So I don't, it depends upon where you are. In cold climates, electric vehicles have a problem because the charge can't hold. If you want to drive in the middle of winter between Calgary and Edmonton, you're not even getting to Red Deer before you got to charge up again. So to me, owning an electric vehicle and driving it in the winter, on the highway is not it. That's why everybody owns trucks, Ford 150s or GM trucks or Ram trucks. For city driving, it makes sense because you can go to home and charge up or find a fast charging. So I think you almost, if you're going to own an electric vehicle, you have to take the view the electric vehicle is for in town, and my SUV or truck is for driving out in the country. If you want to go to your cottage in Kelowna or, go to Banff or wherever you're going. And for me, driving up to Edmonton, I need a gasoline, premium gasoline fueled vehicle.
Do you think the push for Alberta to leave Canada will have any effect on the oil and gas industry in Alberta?
That's the $1 million question. It depends upon what Ottawa does. And if Ottawa is very anti-fossil fuels, then the Premier has put through and passed legislation where the number of people you need to sign a petition for that a vote on separation, that would happen. If that separation vote was unanimous and a high percentage of the population voted for it, then all of a sudden the negotiations between Ottawa and Alberta occur. And I think that's when the Premier, who wants to be a Canadian, wants to stay in Canada, will finally have equal opportunity to fight back against Ottawa's, noxious approach to energy and get them to back down. Because if we leave, if Saskatchewan, Alberta leave, that's a hell of a lot of money not going into the federal coffers. And, even left-wing nut bars, the dollar makes a difference.
Can you tell us where our listeners can subscribe to the Schachter.Energy Report?
Yeah, for the Schachter.Energy Report, where we cover 37 companies and you will get directly the eye on energy, you can go to www.Schachter, Schachter, energyreport.ca. So again, www.Schachter.energyreport.ca. And you can then go to our website, and you can see there's a quarterly option or an annual option. And we'd love to have you join our subscriber group. We think the markets are going to be very favorable to the energy sector between now and the end of the decade into the early part of the decade. And, when you don't want to own energy stocks for long term. It's not like you buy an IBM or you buy an Apple and put it away. This is an industry where you rent the stocks, and you rented them from 74 to 81. You rented them from 99 to 08. You rented them from 2020 into the end of the decade. There's going to be big swings that traders can take advantage of, overbought, oversold. But the reality is, if you buy good quality names, like you bought March of 2020, you could buy Tourmaline under $10. You could buy Paramount under $1. You look where those stocks are today, they're up significantly already, even with the correction they've recently had. So, if you stay with them for the cycle and you buy them during one of these troughs, it's a fabulous business to be invested in. But at some point, I will use the 4-letter word sell, and that could be, 2029, it could be 2032, I don't know. But I'll be watching, and you say to me, well, Joseph, how are you going to know when to sell? I'll be watching the smartest people in the industry who own companies who've, built one after another, and sold them to international. Like right now, the international players are getting out of Canada because they're worried about our left-wing government and the tariffs and all the rest of it. And we've seen, Chevron sell out and other companies sell out over the years. But when the top of the cycle comes, barrel capture is important for these multinationals, and we see them coming back into Canada later in the cycle where they know there's risk in owning reserves in the Middle East or other places where politics are bad, maybe South America, and all of a sudden with Canada being the fourth largest energy producer with massive reserves, all of a sudden reserve capture in a safe country, and maybe with a government that's a lot more supportive, that would bring everybody back into Canada. And of course, the prices that they would pay would be much higher than they are today.
And can you tell us about your special offer again?
Yeah, for people who would like to see the Ion Energy, the macro piece, and it'll have more of a U.S. Background to it in 3 months down the road, just go to Substack. And it's either under Ion Energy or Schachter.Energy, and you can go sign up. We're seeing a very high response rate on that right now, since we announced it this week, and we'll be talking about it regularly with people. And 3 months from now, that'll go to a paid product, annual subscription, $250, monthly issue, which means 4 issues a month, $30. So it's a very reasonable price for people to have a handle on the macro side of the energy sector, and then if they would like to know about the individual securities, then they have to go to the paid product on the SCR side, and we've talked about that already, and they can get that on our website.
Joseph, thank you so much for being on This Week in Money.
My pleasure, Jim.
My guest has been Josef Schachter, founder of the Schachter.Energy Report online at Schachter.Energy.ca. He was speaking to us from Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Gerald Celente, David Skarica, and Josef Schachter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.